The Morgan Report with David Morgan.
David Morgan with you with the weekly perspective for the week ending 10 January 2020. So start off with an article from Reuters. World Bank trims 2020 growth forecast amid slow recovery for trade and investment. The World Bank on Wednesday trimmed its global forecasts for 2019 and 2020 due to shorter than expected recovery in trade and investment, despite cooler trade tensions between the United States and China. The Multilateral Development Bank said 2019 marked the weakest economic expansion since the global financial crisis a decade ago, and 2020, while a slight improvement, remained vulnerable to uncertainties over trade and geopolitical tensions. So basically a theme I've been going over almost every week. Yes, there's some improvement in the U.S. Yes, there are areas and pockets that are doing well, but overall, the contraction in the global economy continues. And continuing that theme, another Reuters, Germany's misery continues as industrial orders fall unexpectedly. German industrial orders fell unexpectedly in November on weak foreign demand and lack of major contracts, data showed Wednesday, suggesting that a manufacturing slump will continue to curtail growth in Europe's largest economy. Germany's export-dependent manufacturers are struggling with sluggish demand from abroad, as well as business uncertainty linked to trade disputes and Britain's decision to leave the European Union. Folks, this is only going to get more interesting this year. The auto sector is huge on a global basis. Lots of jobs, lots of natural resources, lots of metals, plastics, etc. This is from Wolf Street. Wolf Richter. Australia's new vehicle sales dropped to lowest since 2011. Australia is next as we are tracking the decline in global new vehicle sales that started in the U.S. in 2017 and took on serious dimensions in 2018, with vehicles falling for the first time in modern China, the largest automaker in the world. New vehicle sales in Australia fell 7.8% in 2019, with just over 1 million units, the lowest since 2011. So just further verification of what I have been speaking about. And another thoughtful article from Charles Hugh Smith. The Fed can't reverse the decline of financialization and globalization. Always worth a read. This will be up probably over the weekend, and this won't take too long to read the whole thing. A couple key elements. First of all, he talks about globalization is the transfer of risk from the owners of capital, read banks and corporations mostly. There are some wealthy individuals, we know that, to the workers and public resources. Examples of this transfer of risk abound. Rather than pay workers' benefits, corporations game the part-time, full-time labor laws, so workers' health insurance is paid by the taxpayers. Corporations pay wages too low to survive, so workers depend on public sector assistance. Financialization is the exploitation of assets and income that were previously safe by those with access to lower-cost central bank credit. While definitions vary, mine is financialization is the mass commoditization of debt collateralized by previously unsecuritized assets, a pyramiding of risk and speculation that is only possible in a massively expansion of low-cost credit and leverage for those at the top of the wealth power pyramid, financiers, banks, and corporations. Well worth the read. He and I are in agreement on almost everything. Well written, as always. More proof, really, of the contraction in the economy. This, of course, is on the United States. And this is from CNBC. Macy's is closing nearly 30 stores. Here is a map of where they are. And you can look at this if you're seeing the video. If you're on the podcast, it really doesn't matter. Most of them are east of the Mississippi, and there are a few out in the west. Macy's said Wednesday it will shutter nearly 30 stores in an effort to boost its profitability and focus on its most profitable stores. A new wave of closures follows holiday sales that were not quite as bad as some had feared. The news sent Macy's stock higher. Share prices rose 2.4%. So again, more contraction. And of course, a lot of people say, well, it's because of the internet and everyone's buying things off of Amazon and that type of situation, which certainly is a contributor. But the real bottom line on this contraction is that the middle class is getting wiped out. We have too much stuff anyway. A lot of people are just not buying things because, one, they can't afford it, or two, they don't need it. So this is the contraction. This is where you get to the reign of plenty. This is where there's so much stuff in the West. I'm not talking about, the billions of people that survive on $2 a day or less. That's not what I'm addressing here. What I'm addressing is mostly the West, the Anglo-American empire, where most people, whether they believe it or not, have too much. And what I mean by that is they're living a lifestyle that is rather wasteful. And you're truly is included in this. I'm not going to exempt myself. But that's part of the reason that you see these stores closing. They're just not buying. Why aren't they? Well, one is money. They don't have it. And the other is really, I don't need anything else. I've got more than I need. If something wears out, I'll replace it. But until that happens, I'm good. Of course, consumables like food, that's a whole different story. And I'm still pretty high on the upcoming food problems that we'll witness pretty much on a global basis. But I may get to that later today. I'm not sure how far I'm going with this report. This is from Traders Magazine. The concept of U.S. dollar collapse goes mainstream. This is an editorial from January 7th. Over history, all currencies backed by pure fiat monetary systems come to an end in one way or another. Sounds like yours truly. I've often said that on almost every interview I've ever done. Whether it was recently with the euro replacing various European currencies like the Portuguese real in 1999, or during ancient times with the fall of the denarius, the currency of the Roman Empire, 274, the transition from a sound to unsustainable monetary system is particularly common when currencies gain reserve status, which in itself is the cause of the demise. Still today, if you ask most people about the U.S. dollar, they have yet to question its stability. Despite the greenback being on a gold standard for the majority of the last 200 years, recently the currency has been supported by a fiat system, and the rest of the world has gone along with it. Mainstream financial media, who normally don't have the opportunity to delve deeper into technical aspects of the monetary system, are beginning to publish articles on the death of the U.S. dollar. Meantime, even prominent central bankers are considering alternatives. At the annual Jackson Hole meeting, Mark Carney from the Bank of England hinted at the idea of a crypto-backed system playing the role as the new global reserve currency. Pay attention, people. This is the direction that the banking elite really want to push us. I am pretty certain of that statement. Over the past decade, we've started to see real evidence of the U.S. dollar becoming unfavorable. It's not just gold, it's oil too. Following the introduction of sanctions implemented by President Trump, the Iranians have been searching for an alternative medium of exchange while their currency, the rial, continues to depreciate against the greenback. It is evident that the world is waking up to the negatives of the greenback's reserve currency status, but what would be a suitable replacement? Now the countless new exotic forms of money produce a dilemma for anyone trying to predict the U.S. dollar successor. History tells us it's a gold standard, and I would certainly say that is what history has shown us. But we are in a new paradigm, potentially. Not out of choice, but out of necessity to restore stability during a monetary regime change. Yet this time there are new contenders. Cryptocurrencies like Bitcoin that bring back power to the people, and other currencies that preserve institutional power like the IMF's infamous SDRs. With the world's applying an ever-increasing amount of pressure on the greenback in capacity and complexity, it's not a matter of if, but when the U.S. dollar will be forced to make way for a new reserve currency. Now, I'll move on to gold somewhat briefly. I could go on and on, but gold closes at nearly a 7-year high. This came from Market Watch. Previous version of this report was out earlier. Gold futures Monday, that's Monday of this week, had the highest settlement since April of 2013. It got above 1550. Let me move. This is from Kitco. Gold's $1,500 levels, looking like the new 2020 floor. Kitco News. Gold's strong start for the year has put prices well above the previous metal's hard floor, $14.50 an ounce. And I don't know where these people get these numbers, and it's fine. I mean, you can write anything you want. It's a free market out there, somewhat. But anyway, 1,500 is looking increasingly like the new 2020 floor. I would argue 1,550 is the level I want to see maintained. That was the high basically seen after the 1,350 breakout last year, which took basically 6 years to do. We broke out above that And we've remained above there ever since, once we finally did break that level. Now we are looking to move up and hopefully create a new floor at a new higher price, which is almost inevitable. And it remains to be determined what that is. Again, 1550 would be the optimum for the bullish case of gold. And so far, as I'm doing this report on Friday, gold is at 1558 basis Kitco's Kitco. So anyway, we'll see. I think it will, but there was more down volume than up volume in the last few days. I'd have to see more data to stick my neck out any further than I just did. But I am looking for a good return on gold and silver even this year. And I did do an average on what we did in our top tier picks, and we averaged a 63% gain for 2019 to 2020, from January 3rd, 2019 to January 3rd, 2020. If you bought all 7 of those stocks, which I actually recommend you only need like 3, but regardless, that would have brought you a 63% gain. And I haven't checked most of the money managers that manage gold funds, but I would hasten to say it most likely beat most of the averages, and there's reasons for that I won't go into at this time. And I'll finish up with this article from Gold Money. I would encourage you, if you are invested in gold or thinking about it, you probably should read this article. And it talks about the economic conditions that will drive gold prices higher in 2020. I agree. I don't agree with the entire article, but there's a little I disagree with. In 2019, priced in dollars, gold rose 18% and silver 15%. The Bank of Japan is still buying bonds, but at a pace which is expected to fall beneath redemptions of existing holdings. Gold in the context of distorted markets. At the core of current market distortions is a combination of interest rate suppression and bank regulation. It's unnecessary to belabor the point about interest rates because minimal and even negative rates have demonstrably failed to stimulate anything other than asset prices into bubble territory. Well said. So again, I encourage you to read this. I expect that the gold and silver prices will do at least as well as they did last year. I do expect somewhat better than that. I think you could see 20% in gold, 30% in silver. Remains to be determined. I do expect these stocks to outperform, especially if you choose wisely. And I'll leave it at that. It's good to be back with you in the new year. I'm almost over this cold. I hopefully didn't mess up too much of what I stated with sniffing here. And I will be back with you next week for another weekly perspective. And if you're so inclined, you can go to the main website and explore the Morgan Report subscription services. They're all explained under the tab Subscribe, and they're fairly detailed with the video, which I'll probably need to update. But it talks about what we do on the analysis, the model portfolio, the trading that I show you, or actually put it in front of you and speak to it. Research that we do, and sometimes we're the first on new discoveries, and we have been on this electronic waste, where I just did an interview with Aaron Scott, which will be posted to those that are on our mailing list. So I'll be back with you next week, folks, and updating you on the global economy and the precious metals. Hello, I'm David Morgan, publisher of the Morgan Report, and as some of you may already know, the Morgan Report is about money, metals, and mining. In fact, we cover all resources, from rare earth elements to precious metals. I've been publishing on the internet for about 20 years. My primary passion is to help people build and preserve their wealth. I love to make people millionaires. I've helped thousands of people via our research in the Morgan Report, which has thousands of paid members and 10 times that amount on our free weekly updates. Here's what you'll receive from our free newsletter. To-the-point webinars, weekly analysis of the financial markets, interviews and our conference schedule, special reports such as riches and resources, and various metals price forecasts. Our paid service client base is primarily small to medium-sized business owners, professionals in the industry, or the seasoned investor who understands markets and the value of precious metals. My area of expertise includes equity analysis throughout the resource sector, energy metals, base metals. We cover startups to billion-dollar corporations. We focus on a special sector that makes money regardless of price oscillations, and the importance of precious metals due to the ongoing currency devaluations. Our team of 3 analysts and support staff can help you build and protect your wealth. It's important for you to know what other people have said. We're passionate about what we do. High integrity and trust. Tell the truth and own it. If we're wrong, we admit it. Take a long-term outlook with major assets, and bet a little to win a lot with speculative situations. If you choose to become a client, you will gain financial insights very few, even professionals, recognize. You'll understand the importance of honesty in our financial system. You will understand how the money system influences almost everything in your life. You'll be prepared for the ongoing currency crisis. And finally, I've chosen to make my life's mission greater than the individual, which means my mission statement is to teach and empower people to understand the benefits of an honest monetary and financial system. It's been a great journey so far, and the best gains in this sector lie ahead over the next 3 to 5 years. I'm fortunate to have earned the status of being a leading authority in my field in helping others protect their wealth. You can email me at support@themorganreport.com or call my office at 480-325-0230.